Good morning, everybody. Hope you had a nice week. So this is the second little coffee with Kirk that we're doing. Again, I'm going to try to do these every week and give a little bit of presentation, but it's mostly just so you can kind of ask me some questions. Again, with all the chaos that's going on, I know there's a lot of questions people have, and a lot of folks have kind of the same questions. So we'll just try to do this to have more communication and also give me an opportunity to kind of just show you what I'm thinking at each time. So today, it's not going to be too much with investments and all that kind of good stuff, but some other little topics. Let me share my screen real quick. Bring up my presentation. Okay. So the agenda real quick, we'll spend a small amount of time talking about the markets, what they're doing this week. They had a really good week. Tell you what we're going to do now, actions to take, some things that you could think about doing in your own personal finances to try to improve them with all this chaos going on around, and then some questions. First, I just want to throw it out here to see who can give me some feedback. My hair is just getting crazy. I can't, I'm not used to having longer hair. I think it goes all the way back to my military days. So this is like, I feel like a hippie right now with my hair looking like this, and there's no haircuts. I can't get a haircut. I'm going to look like this guy pretty soon if I don't get a haircut. So the poll is, should I just let it grow and look like this? Or should I'm going to just take my clippers and have my kids shave my head. I don't know what to do. So if you have any feedback, just let me know what you think I should do. But yesterday it was really windy, and that's about what my hair looked like. I have really wavy hair. Or if you know any underground haircut places, not street cred or anything like that, if you know something like that, let me know. So anyway, jumping into the market. So it was a really good year, or a really good week for the markets. And we're probably going to be getting back in. I talked about last week, your typical bear market. What happens usually is a sharp drop followed by a very sharp move up, which we kind of saw the start of last week, and it could continue to go more. Now, if this is a true bear market, we start to see it fade again. So what we're seeing now, if it's a real bear market, it's not going to hold, but it could still bounce another 10, 15% from here and not be out of the norm. So that's kind of what I'm looking at. And again, what I'm focused on is a very short-term metric. Usually I use the 200-day moving average. I'm bringing that down to 20-day moving average. So if it fades back down, we're not going to take this thing all the way down with it. Now, like I talked about last time, this could just be something like, a snowstorm, a blizzard. I can't imagine it would be that way, but who knows? Maybe we end up back up at the top. And the big reason that we had a move this week was the Federal Reserve has basically gotten to the point where they're going to be buying everything except stocks. They came out today or this week and said that they're now going to be even buying what they call junk bonds. Junk bonds are lower quality bonds, or companies that don't have as good a balance sheet. They're not investment grade. Investment grade is what you want, right? The Johnson & Johnsons, companies like that, Coca-Cola's, they're looking at junk bonds, and that had a big impact on the markets. And next week, I'm going to actually take the time and talk about the Federal Reserve. Not many people really understand what the Federal Reserve is. They hear about it in the news all the time. So I'm going to give you a little bit of an overview of the history of the Fed, what its functions are, and what it's been doing lately. So you can kind of see, because I think what most people don't realize is this junk bond buying is structured where the Fed is going to go out and buy bonds of bad companies, but the Fed is prohibited from having any losses in their portfolio. They cannot buy any kind of instrument where they have a loss. So $450 billion of the $2 trillion relief fund that Congress passed, 450 of it is basically going into a fund that's going to backstop what the Fed does. So essentially what that means is any losses that the Fed incurs, they're going to start pulling from that line of equity or line of credit from the Fed or from the government, $450 billion. So they could take up to $450 billion of losses and just pass it right straight to us, the taxpayers. And of course, if they start to use that up, you can imagine that the Treasury Secretary is going to go back to Congress and try to get even more money. So it's really nefarious, but we'll get into that next week. So that's my little tease for next week. So we'll talk about a few things you can do right now to make sure that you're maximizing your personal finances. The first thing that you should be doing is just make sure that your portfolio matches your risk tolerance. What I have found since the market has gone down, and not so much with my clients, but a lot of people inquiring, give me calls, things along those lines. So many people had portfolios with just too many stocks. Part of that could be they thought interest rates were really low, so they invested heavier into stocks. Some people they had the right allocation, but they never rebalanced, and their stock portfolio got to be a bigger part of their overall allocation. And then when the market came down, they got really scared. So if the drop we had in February and March, really got to you, then you probably had a little bit too aggressive portfolio. Now, you never want to make panic changes. You never want to do something because you're panicking. But by the same token, you really want to look and make sure that your plan matches what you are as a person. Is it match your risk capacity? If not, it's always a good time to make changes if you're doing it not based out of panic, but based on we were a little bit off on our allocation. So if you're a client or if you're not a client, we use this tool that basically creates a risk number and gives you an idea of kind of what you might be able to handle over a 6-month period. How much could you handle down? What could you expect in the upside? And we just try to find that sweet spot as far as how much risk you're willing to take. And then once you know that, once you're comfortable, okay, I can handle this over a 6-month period, now you've got your portfolio, you've got your plan, and it's just sticking with it at that point, no matter what the markets do. But I just find that so many people didn't have any idea really what was going on with their portfolio and the risk, and it gets exposed when things go down. Nobody really cares if they're too aggressive when the market's going up. They love it. It's when it turns the other way that problems arise. So the first thing you want to do is make sure your portfolio kind of matches what you can handle as risk. The second thing is what everybody does, individuals, companies, well, maybe not government so much, but during a recession, you look at your expenses to make sure that everything is absolutely essential. Anything that's not essential during a recession usually gets scuttled. So you should be doing the same thing with your budget. This is a great time to go and really dig in and see what what leaks in your budget you have that you're really not using. And the first thing is subscriptions. I mean, everything now is subscription based. There's nothing that you can just kind of buy one time. I mean, if you wanted to, you could have 1 million different subscriptions, all the different Washington Post and New York Times, and everything's a subscription. So you probably have some subscriptions that you're just not using. I always talk about Planet Fitness. There's so many people I've seen, when we look at their budget and we see that line item, it's only $10 a month on Planet Fitness. I say, well, how much are you going to Planet Fitness? They're like, well, we don't really go, but it's kind of a pain to cancel. Now's a good time to get rid of it. All those kind of things you want to look and see if there's some leaks in your budget. TV subscriptions, do you have tons of different subscriptions for that? HBO and Showtime and Netflix, plus Amazon Prime, plus Roku and all this stuff. So there's a lot of them that you could really start to narrow down and cut your budget. Insurances are always a good thing to look at. Every couple of years, you should be looking at your auto, home, and if you have a business, you should look at business lines just to make sure you're not overpaying for your insurances. It's also a good chance to make sure you've got enough insurance. I mean, sometimes people will have a policy in place for years and they won't find out till something happens that they didn't actually have the right coverage. So it's not a bad idea to even look at it for that reason. But cell phones, so many people have just the full the full cell phone plan, unlimited data, and they don't use any data. Cable plan's another one. Take a look at that. Another good thing to look at with interest rates so low right now, trying to get any interest is really difficult. So it's not a bad idea to look and see if you can get something, even if it's a 0.5% more. It's not going to make you rich, but it's a good way to get a little bit extra in your budget. So I always talk about online money markets. So these are money markets. They're FDIC-backed organizations. And what they do is they just offer a little bit higher interest rate because they're not going to give you checks. There's no branches you're walking into. They link in with your checking account. So you can just move money back and forth between your checking and these online money markets. But a lot of them are paying, right now it's about 1.2%. But that's still, it's 1.2%, whereas your checking at Bank of America or Wells Fargo is probably paying you a fraction of a percent. So there's a lot of little things to do, but just try to look at your budget, find some savings. It's a great time to do that. And the easiest way to track your expenses, there's a lot of great tools out there that can help you do this without much effort on your part. It can happen automatically. Now, you could be old school and just want to do pencil and paper or get an Excel sheet or something like that. Or maybe you got one of the old Quicken programs from years ago that download everything. But there's now online tools that do this for you. One of the most popular ones is Mint. So it's just mint.com. Another good one is Personal Capital. I will warn you with Personal Capital, though, once you get everything in there, they start to bombard you with inquiries, and they've got a financial planning arm. They've got credit card sales, all kinds of stuff. So you're going to get pestered a little bit with that. But we even have something through our planning software. So if you're not already using it, it's a great opportunity to do it. Just let me know if you're interested. It's backed by Yodlee. Yodlee actually is the back-end software for Personal Capital as well. But what these things do is they're account aggregators. So you do give them your username and password for different accounts. They get a limited power of attorney to do what they call screen scrape technology, where they just pull over all your transactions from your bank accounts, from your credit cards, from your brokerage statements, all of that, and they bring it all together. So you get a 360 view of your finances. But the beautiful thing is it tracks your budget and it'll categorize it for you. So if you go to a restaurant, if you go to McDonald's or Starbucks or something like that, it's going to categorize it automatically. So you're going to get a full view of your finances, you're spending right away. Like for me, I spend maybe 10 minutes a month doing updating this thing. That's it for my own personal finances. So I just have to go in, and you do have to recategorize some expenses. It may not have categorized it correctly. And then if you do write checks, it doesn't know what the check number, say check number 420, you've got to go in and say, okay, that was for taxes. And then you categorize it. But you get a quick view of where your money's going, and you can start to find out where you've got those leaks in your budget. Another thing you want to think about doing, if you haven't, is refinance any debt that you've got, especially home loans, if you still have them. I mean, hopefully everybody watching's got everything paid off. That would be great. But, that's just not the reality in America today. But mortgage rates have been plummeting. They're probably not as low as you would think, considering the 10-year treasury, which is what mortgage-backed bonds are tied to, that's below 1%. So you would think mortgages could actually be under 3%. But the problem is there's not a lot of liquidity in the bond markets because there's so much uncertainty that mortgages haven't been getting to investors as quickly. So the interest rates haven't come down quite as much as I would think, consider how much the 10-year treasuries come down, but they're still really low. And this is just a graph showing you the past year, what mortgage rates have done. So we've gone from over 4% down to right now, the current one was 3.3% for a 30-year mortgage. So it's not a bad idea. The other thing too, rates for 20-year mortgages and 15-year mortgages are even lower. So personally, I'm refinancing into a 15-year mortgage. Just to it'll cut a couple years off my mortgage, and I'm pretty much going to be paying what I'm paying on a 30-year with a 15-year. So it's something to look at. You can do for auto loans too. A lot of them are coming in with really low auto loans. So if you have a loan already for your automobile, take a look. You might be able to get something lower. The only thing that's not coming down is credit cards. They're still charging their 18 to 20% for credit cards. and they're not moving at all in that. So even though interest rates are so low for them, they're not passing that along to consumers. The fourth thing to think about right now is doing some Roth conversions. And I'm saying this for a couple different reasons. This is really something you really want to think about if you have any intention to leave money to beneficiaries. If you have kids or grandkids that you'd like to leave an inheritance to, the Roth is going to be the optimal way to do it. And that's for a couple different reasons. One, tax brackets. So right now we are experiencing the lowest tax brackets I think we'll ever experience in our lifetime. I just can't imagine that they're going to go lower. The government's going to be now, the budget deficit is going to be about 12% of our gross domestic product this year. That's just the deficit. So, we're looking at a $3 trillion deficit just this year alone at a minimum. That's if tax revenues come in like they were last year, which they're not going to. They're probably going to be much lower. So we're looking at least $3, probably $4 trillion of a deficit. That's unbelievable. So at some point, rates have got to go up. They just do. Either that, or we're just going to, just print money. And we'll talk about that again next week. But that, they're going to go up. They're going to go up. So you might as well take advantage of them now. So what you can do is try to find out what tax bracket you're in. So this is the tax brackets for 2020. You can see you go all the way from 10% up to 37%. Find out which one you're in. And at a minimum, you want to fill up the bucket that you're in. So if you're in a 22% tax bracket, let's say you're married. So you have a range between $80,000 of taxable income to $171,000. Well, let's say your taxable income is $100,000. That means you've got $70K that you can create income, taxable income on, and still stay within the 22% bracket. So it's a great opportunity to take $70,000 from traditional investments, IRAs or 401ks, and convert that over to a Roth of some sort and stay within the same tax bracket. So you're not, you're going to pay taxes on the amount you convert, but you're going to stay in that same bracket. So you're not going to get pushed into a higher bracket. The other reason you'd want to think about this is there's a new law that got passed at the end of 2019. And it wasn't its own law. It was put onto the budget bill. So it's one of those, like on page 400 of the 1,000-page budget bill, Congress put in the Secure Act. This was, securing retirement for citizens of America, something like, how they make those names up. Well, anyway, the Secure Act had a lot of good little things it did to try to help people save for retirement. So it had some little, gave us a few carrots, but it brought in a pretty heavy stick too. And I think it was a backdoor tax increase because what it did is it's mandating that any inherited IRAs. So if you pass away and leave your IRA to your kids, the way it worked in 2019 and before is your child would have to start taking a required minimum distribution, an RMD, every single year. But it was based on an actuarial life table for them. So if they inherited and they're 50, that table might have another 40 years before they would actually empty out the account. So they could spread this tax-deferred IRA or 401k for 40 years. Well, the government has now mandated that all IRAs, both traditional and Roths, have to be distributed within 10 years of your passing. So that means they now have to pull out a lot more every single year, which if it's in the traditional IRA or traditional 401k or 403b or TSP, that means they're going to pay tax on it. And usually when people inherit money, they're going to be in their prime earning years. So if you pass away at 80, your children might be in their 50s and they're making as much money as they're ever going to make. They're in their probably highest tax bracket of their lifetime. Now they're going to have this, they're going to inherit it, they're going to have to pull from it over 10 years, and they're going to get pushed in a much higher tax bracket. So this is an opportunity for you, especially if you're retired, to start to take money at lower tax brackets. Again, I think the lowest rates we'll ever see. Convert that to a Roth. So at the very least, when your children or grandchildren inherit these IRAs, that they'll be in a Roth. So they're not going to be taxed on the distributions. They'll still have to take it over 10 years, but they're not going to get hammered by taxes with it. So a great thing to think about is doing a Roth conversion. Why is it another great reason to think about Roths right now? Well, if your accounts have lost value, as so many have, you can start to convert now. And when things pick back up, you're going to get that. You convert it over when it's lower. Now you're going to get tax-free growth when things start to pick back up. So those reasons make it a great time to think about doing a Roth conversion. Now, if you don't really have interest in passing things along to heirs, or if you don't have a lot of your net worth tied up into IRAs or something along those lines, or if you have a charitable, if you have charitable ideas, a lot of times it's a great idea to leave your IRAs to charities because they don't pay tax. So if those are the things, maybe you don't need to think about the Roth conversions, but otherwise you do. And if you're younger, I think thinking about Roth conversions is a good idea too, because you've got a long time for that tax-free growth to hit. And again, we're in the lowest tax bracket. So, in 2025, the tax brackets we're in right now expire automatically. So at a minimum, we're going to go back to what they were in 2017. So all of these tax rates you see here from 10 to 37 basically jump from 3 or 4%. Now 10% stays the same, but 12% goes to 15, 22 goes to 25, 24 goes to 28. So you can see no matter what, they're going to go up. But I think they'll go up even higher than that. So the fifth thing to think about is something called tax loss harvesting. So this is for accounts that are non-IRA, non-401k, basically non-retirement. So within the retirement plans, obviously you can buy and sell all you want. You're not taxed until you pierced the IRA wrapper and pull something out. So this is for assets that are outside of retirement accounts. These are where you're going to be facing capital gains or capital losses. So anytime you buy or sell within a taxable account, you're going to have a tax issue. So what is harvesting? Well, what it means is if you have positions with a loss, you sell it and take the loss now. And considering the markets have dropped, it's probably safe to say that a lot of people either have losses or even the gains that they had have pared back quite a bit. So this graph gives you kind of a quick idea of what a tax loss harvesting might look like. Now, here we have $20,000 investment, and let's say it loses $6,000. So if you sell, you've got a $6,000 loss for tax purposes that go to your tax return. Now you can't buy, there is one rule, you cannot buy the same exact holding back within 30 days if you take a loss. If you do that, the government does not allow the loss. Now, if it's an individual stock, it's tougher to do. You've got to wait that 30 days. So if you sold Apple and you want to own Apple, you've got to wait 30 days to buy it back. But if it's, say, an S&P 500 fund, well, you could easily find a replacement. If you had the Vanguard 500 fund, you could go to a Fidelity Total Stock Market Fund or something like that, where it's enough of a difference to where it's not the same kind of holding. So that's the only caveat to the tax loss. You cannot buy an identical or similar investment within 30 days, but there's so many ways around that. Unless it's an individual stock you love, then you have to wait 30 days. But what you do, let's say you buy something similar. You sell the S&P 500 fund from Vanguard, and you buy the Fidelity Total Stock Market, and it goes back up. You get that $6,000 back, so you're back to $20,000 whole. Now you've got $6,000 of losses. So you could, if you wanted to, you could sell that position, and you're not going to have any taxes. You might say, well, why would I do that? I could have just held the same holding, lost $6,000, picks it back up, and I have no taxes. Well, the power of the tax loss harvesting is a couple different things. One, let's say you take the loss this year, and then you write it off on your tax return. So you've made a financial windfall. You've made a good decision. You're going to save some tax dollars this year. And then next year you take the gain. So you've got that time value of money. You've taken advantage of your tax situation, your tax rates now. So you're getting a benefit that way. The other thing that's nice about tax loss harvesting is you sell some of your losing positions, and then you can sell some of your winners, and you offset the gains with the losses. So you bring down your tax, your taxability overall by strategically selling some losers and then selling some winners. And then you can buy the winners back, and you've basically paid no tax on the winnings or the earnings, and then you can continue on with earnings from there. So there's a lot of different things you can do. There's a lot of little ways to make this work. Even if you say, I started with 20 and I ended up with 20, what's the difference? Why would I take the loss? There's reason to do it. So the time value of money, of getting that tax, the tax loss in the current year, or even being able to take a tax loss and then sell another winning position. So it's a great way to do that. But the big reason you might want to do it is also looking at when you take the loss. So if you know things about capital gains, anything held less than a year is taxed at your ordinary income tax rate. So if you're in the 22% tax bracket, if you sell something within a year and you have a gain, you're taxed at 22%, not the long-term capital gain rate. Anything held longer than a year is only taxed at 15%. So you could have a situation where you sell something at a loss if it's short term, and you're going to get a much higher tax break than if you just had a long-term loss. And then you buy back something similar and you hold it for more than a year and you sell and get the gain. Now you're only paying 15%. So you're getting kind of a tax arbitrage, if you will. Another way to think about it too is if you are close to retirement, this is a good thing. You take the loss now when you're in a much higher tax bracket, buy back the same holding in 30 days or something similar. And then later on, once you're in retirement, you sell it and you're going to have it at a lower tax bracket. Or if you hold it more than a year, you're definitely going to be at 15%. This example on this screen is really looking at not just the tax rate that somebody's in, but it's saying, okay, if you're in a higher tax rate and you take a capital gain, there are additional taxes beyond the 15%, even for long term. If your income's high enough, you end up with an additional Medicare tax. So you throw in another 2.8% on that. And then there's just another tax for folks who make, I think it's over $200,000 for married filing joint. And so there's another 1% on that. So you can be strategic in your tax loss harvesting with this. So because people have losses right now, it's a great idea to take a look and see if you could optimize your tax situation that way. Here's another one that could be a little controversial for some people. I would recommend looking to sell real estate now. Now, I'm not necessarily talking about your primary home. If it's a place that you're going to live for a long time, this is your home. Don't worry about it. Ignore this. But I've seen so many people, especially boomers, are carrying more than one home right now. A lot of folks, a lot of clients in Florida, they snowbird. But the carrying cost of having two homes can be high. But because the markets are doing so well, the stock markets, everything like that, you didn't really mind the carrying cost. Well, now we're in a situation where a lot of the boomers are seeing their values of their IRAs and their taxable investments go down, getting a little nervous. Now those costs they catch up a little bit. Paying 2 utility bills every month gets a little bit more painful. Having 2 tax bills for property taxes, all that kind of stuff does get a little bit more painful. So you might see some selling. Also the fact the boomers are, you guys are getting older. So at some point carrying 2 homes and the upkeep with that gets to be a little bit laborious. So I think we see over the next 10 years, there's going to be a lot of homes coming onto the market. And my advice here is you might want to think about selling before people are forced to sell. That's the key thing. Right now, home prices are historically high. You would think that after what we went through in 2005 to 2008, that things would have moderated and kind of normalized. But because interest rates came so low, supply has been low, we're seeing a lot of homes that are high priced. So historically, the value of a home is usually 3 to 4 times income. Right now, we're over 5. So if you took out the bubble period from 05 to 08, if you took that out, which we were pushing well over 5%, 5 times income, didn't get to 6, but pretty close. If you just ignored that, 5.1 times income would be historically high. So we have high valuations right now, and this recession is just kind of getting going. The good thing is there isn't a lot of inventory right now. So if you were able to get things moving, if you have a second home, vacation home, or something like that, a rental property you've been thinking about selling, low inventory, things would still move right now. I can't tell you what might happen a year from now. So if this thing doesn't get any better, a year from now, you might have forced liquidations from people. Now you've got a lot of inventory and you're going to see prices come back. So it might not be a bad idea if you've been thinking about it to look to do something along those lines. I was just reading an article a couple of days ago talking about Airbnb. Now, you may have done an Airbnb. It's taken over for hotels. But what's happened is there's a lot of people. They come these super users. So when you go on and you see somebody who's a super user with Airbnb, it usually means they have 7, 8, 9 places. Well, they're going to get decimated here. They've got 7, 8, 9 mortgages. They've been doing well because the Airbnb, they're charging essentially 2 or 3 times what they normally would get if they just rented it out for the full month, if they had a full-time tenant. But what happens if people aren't taking vacations? So they're going to be forced to liquidate. So I think, you'd have to move pretty quickly, but I think you could be ahead of the curve here if you've been thinking about selling real estate. Getting back to the boomers, right now, the Zillow estimates there's going to be 20 million homes from the boomers that go on sale in the next 10 years. So that's like a third of all the homes that are owned in the entire U.S. are owned by boomers. A lot of these are second home, 9 million second homes in the U.S., most of them owned by the boomers. So, what's that going to do? The other thing that could affect real estate is we're starting to see with standard deduction with the Trump tax bill is so high that it's really difficult now to itemize. So you kind of lost the tax deduction. You're capped on your real estate and state income taxes to $10,000. So if you own 2 homes and you're paying $3,000-$4,000 for property tax of each one, and then you have state income taxes on top of that, you're going to be capped. So you find out that's really not as good a tax break as it used to be. And the other thing is right now we have all the states are, because of the situation, are throwing around a lot of money. And they, unlike the federal government, states and localities, cities, things like that, most of them have a balanced budget a mandate. They can't go into debt. Now they can issue bonds if they're going to build a bridge or a new school, but they can't just go into debt. So property taxes are probably going to have to go up. And that's one area that they always hit people because you got to live somewhere. They raise your taxes on your property and you can't sell it. I mean, if unless you're going to relocate completely, they've got you. So I think that's one area. So it's kind of it's a little bit out there right there. But I think that if you've been thinking about it, it's not a bad idea to think about selling a real estate if you're going to downsize, or if you were thinking about, you've got a rental property or, something like that. It's not a bad idea to do it now. Well, inventory's low, interest rates are low, and you don't have a mass influx of properties coming on. So that's my idea. If I had a ton of rental properties, I'd probably sell a few just to be strategic about it. So anyway, so I just want to open up now to some questions and answers if anybody has them. I'll take a look here. One question. Okay, do you have an online money market suggestion? Well, the best thing to do is to go to a site called bankrate.com. And what they do is they keep up to date on which ones are paying the most right now. Because the problem is these things change all the time. Every week they fluctuate a little. And sometimes some of the banks will have an extra incentive if you're new to them. They'll give you another 0.5% for 6 months. I've been using TIA Bank for a long time. I've had that when it was EverBank, and I've kind of kept with that. But there's a lot of them out there. There's American Express has one, Wells Fargo has one, Goldman Sachs has even come in with one. I mean, there's just a ton. But bankrate.com is the best place to go to see which one might work for you. Okay, let's see what other questions we have here. Okay, so here's a good, really not so much a question, but she's bringing up something. So last week I talked about how if you didn't have a bank account on file with the IRS, as they start to issue these $1,200 or $2,400 checks, they were just going to mail you a check. That's what they were going to do. But if you wanted to get them your bank information, you could call them. Well, they have now created a link on the IRS site where you can go in and just register your bank with them electronically. So that's fantastic. It's going to save them time, but it's certainly going to save you time, because I was also talking about last week how you're looking at least an hour of wait time just to talk to them, a minimum. So now you just go to the homepage, irs.gov, and make sure that you it's right there. They're trying to drive everybody to it. You'll see it right there. You can go in. So if you're somebody who's just on Social Security and you don't file a tax return, or if you just don't have a bank account on file with them, you can do it that way. So that's a great opportunity. Free online sources for budget for 20-somethings. Yeah, absolutely. Mint.com is probably the best one. It's completely free. There's no cost. Personal Capital, there's no cost to that either. So those two tools I talked about were really great ways. And if you're getting 20-somethings involved with their budget, that's fantastic, because they'll get used to just handling their money. They're not going to go into debt that way. Many of the blue chip stocks are at all-time lows. Can you recommend 3 to 5 that are only going to go back up when we get back to normal? I wish I knew which ones would guarantee to go back up. There's a lot of really good ones out there. I've been looking at Dow Chemical as one. It's gotten just hammered because it's industrial and that's been hit pretty hard. But right now the thing has over a 10% dividend yield. Now, if times stay tough, they're probably going to cut their dividend a little bit. But let's say they even cut it in half. You've got a company that's been around for 90 years and 5% dividend yield. A lot of people like Disney. I want to see Disney's earnings first before what's really going on, because so much of their revenue is theme park based and then movie theaters. And ESPN's another big one. So they own ABC. So they did come out and say, I think they hit 50 million subscribers to their Disney Plus. So that's, $6 a month, 50 million people. That's pretty good. But is that enough to overcome what was happening with losing the movie theaters, losing the theme parks, all of that? I don't know. I need to get some more information, but that's a great company, obviously, that is probably over time going to go back up. Another area that I'm kind of looking at, they're not necessarily the big blue chips, but oil tankers. Now you think, why would you want to do oil tankers with the price of oil so low? Well, here's what's been happening. They haven't stopped production. Even in the U.S., in some way, we're going to subsidize them. And all these other countries that are poorer but need the revenue, like Nigeria, Venezuela, they got to keep pumping. They got to, even if they're barely making any money with it, because they got to have some income coming in. So we're building up all of these reserves. Right now in the U.S., we've already filled up all of the land-based holdings throughout the U.S. So they're now taking on tankers and filling the tankers up, and they're just going to sit at the dock. So a lot of these companies that specialize in shipping are just going to sit there and charge high rates and have really no overhead whatsoever. So that's another area to kind of look at. Okay, here's another question. Some credit card companies will refund your monthly interest if you call them and request it. That's a great idea. Yeah, so anything with the credit cards, anything with your cable company, your credit cards, if you see something that hey, I don't want to pay that fee, call and ask them. A lot of times they'll waive it, or they'll rebate it or something like that. So that's a great recommendation. Let's see, are there no other questions? One other thing I would bring up, if you can watch out for scams. There's a lot of scams going around right now. I don't know if it's because everybody's stuck at home, but a lot more emails are going out requesting information. They're using all the giveaways, the $1,200 check, the $2,400 check, the unemployment. So there's a lot of spam email going around that they're trying to get you to click on. They make it sound like it's something legit, and you click on it and you've got a bug. So be careful with anything that's sent to you. If you get an email or you get a text or something like that talking about how they can help you with getting the most from the government in these times, just go to Google and search it yourself. If it interests you, you'll find it that way. Don't click on any links. Do you think we will test market lows? I mean, if this is a historical bear market, probably. I wouldn't doubt it. In fact, usually most bear markets, you get that sharp drop, you come up, and then you even surpass that low. A lot of it's just going to depend on how long this goes, quite honestly. I mentioned last week, my big fear is this thing goes from a supply and credit issue or supply and demand issue where, okay, people aren't working, people aren't buying, supply issues you can't get all the supplies you want. That's just a kind of a normal recession. But if it morphs into a solvency, I saw 30 million people didn't pay their rent last month. I mean, this is the first month in. If that goes on for 3 or 4 months, now we've got issues where, you got defaults, and that's where it gets ugly. Are you concerned about the funds for PPP running out before small businesses get approved? Yeah, I don't know how they're doing it. Honestly, it wasn't that big. If you think about how many small businesses we have in the U.S., and you're talking 250 billion, it's not enough. So yeah, if you do own a business anyway, you want to get your application in as fast as you can, and just see what happens. That's another area. If you're a business owner, you're getting emails, hey, we can accelerate, get you in there quicker. Click on this link, give us your information. Well, now you've got a virus, so be careful with it. Is it better for a sole proprietor to file for payroll protection program or Maryland unemployment, or can you do both? You can actually do both, but you can't do both at the same time. So if you did the PPP to supplement what lost income you have, you can do that. And then if the way they're going to look at it is if you're using it over the next 8 weeks, if you're using the majority of that to replenish your income, then it can be forgiven. And if you still don't have, at that point, if you still don't have income coming in, you can go to unemployment insurance after that. Will I be bombarded with phone calls from Yodlee, like Personal Capital? Well, Yodlee is the back end software that does it. So, give me a call. I can get you through our planning software. It's exactly the same as Personal Capital, exact same tool, but you're not going to get bombarded at all. Any suggestions for tanker stocks? Yeah, one I'm looking at right now is called Endero. Let's see what else is there. There's a European one as well. I can't think of the ticker off the top of my head, but I'll send you the ticker so you can look at them. But it's a great business model right now because they're going to be able to charge their full shipping rates, and they're not going to be shipping anything. They're not going to be spending money on gas. They're not going to be spending money on personnel, anything. They just sit there, but they get full rates just to hold. And they think it could be up to 1 billion barrels. So you might have 2/3 of the fleet is going to have steady revenue streams and just sit there. It'd almost be like if you got a job and you just sit there and do nothing and they pay you. So it's a good opportunity in tanker stocks. Any medical supply companies? I haven't looked at that. Everybody talks about healthcare, and obviously it's certainly something that with what's going on, but I haven't tried to find out where that's going to be. So many companies so many investors right now trying to find out who's going to come up with the cure, who's going to get the virus first. I mean, at that point, you're risking it. You're not really investing. You're just speculating who you think is going to get it first. Medical supplies, probably a good area to go. Because we're going to have to bring that back home to do some production. But I don't know. I haven't really gotten into that. And here again, it depends on what they end up doing. Some of them still might end up being a better investment, even if they leave their production in China because of lower cost. But But you might have the other opposite end. Somebody brings it back home and then they get more business because they brought it back to the US. So there's a lot of changes in medicine going to happen here. Oddly enough, you would think with this pandemic that hospitals and doctors would be doing better. But the reality is most of the hospital systems are going bankrupt right now, just because a lot of the other services that they do are typically higher profit margin, heart surgeries, knee surgeries, things like that. And they're being overwhelmed with just kind of this routine care that I guess doesn't pay like the surgeries do. So it's an interesting environment. Okay. So it looks like that's all the questions. Again, next week, we'll jump back into another one. I'll get some information out to you. It's going to be a little bit more meatier, a little bit better for people who are nerds, but I think it's really important to really understand what is the Federal Reserve, what do they do, and also what are they doing right now that we should think about. It's kind of scary. So I hope everybody has a great weekend. Hopefully the weather's nice where you're at. It's a little chilly here, but we'll talk to everybody soon.